Reviewing that portion of the Excel sheet for the CAC, customer acquisition cost, that's how much does it cost to acquire a customer, which is perfect right after Fon's presentation, because he just talked about spending money to acquire customers. And so the two kind of tie in together. This is, the financial portion about it to figure out what your CAC is. So if we assume that you had 10,000 visitors to your website, and your search engine marketing cost per click, which he just talked about now, which is great, it's a great lead-in, costs you 50 cents for every click that you got. Then he also talked about conversion, right? The return on ad spend. How much money did he make? How many people converted? Let's assume in this example that the conversion to free trial, so you have a website, a service, an online platform that's freemium. And in that freemium, people are going to visit your platform, whether it be mobile or desktop. And then they're going to go in and sign up, and they're going to become free trial members. And then from free trial, they can upgrade to becoming a premium member. So I'm saying the conversion to free trial is 5%. The conversion to paid is 10%. And also in this example, I'm assuming that your company, you have 5 sales and marketing staff, and that the cost per employee per month is $16,500. So that's how much you're paying your employees per month overall for everything, including benefits. So what is the calculations to determine what's your customer acquisition cost? So you start with 10,000 visitors, and we said that you have 5% convert to free trial. So 10,000 times 5%, you end up with 500 free trial members. And then we said the conversion from free trial to paid is 10. So 10% times the 500 free trial members, you get 50. So in total, you got 50 paid members. All right. And then we determined that your search engine marketing spend was 5,000 because your cost per click is 50 cents. You had 10,000 people that visited your website based on cost per click. So these are all paid visitors. So it costs you $5,000 to end up with 50 paid members. And it costs you for your marketing and sales staff that month, $82,500. So your customer acquisition cost was $100 without the head count. So if you just look at the 5,000 and you divide it by the 50 paid members, it costs you $100 per member. But if you include how much you're paying for employees, which was $82,500, and then the customer acquisition cost, the cost for one customer is $17,500. And so there's sometimes where you would include your sales and marketing staff, and sometimes where you might not include them. You include staff that increases per increased number of customers. So the more customers you have, the more, in a linear fashion, the more staff you have for those customers. Those are considered kind of variable costs. And so those are the staff that you would use. That salespeople are classic for that. Marketing people, not so much. So a lot of times marketing people, they're not getting paid on the number of sales you're making, but salespeople are. But again, it's good to understand what the without head count and with head count. And if you have a question, don't put it to the chat area because I'm not going to see it. Just pipe in and ask the question. So this is for software as a service, customer acquisition cost. So what is it for a product, such as Jader has a product where he's selling the bottles that people will use to fill up the water regardless. He has both a software side, but he also has a product side, hardware side. So this is what it might look like for a customer acquisition cost for a product, all right? So first of all, we have 2.5 salespeople, one pure salesperson, one team composition, one sales engineer, somebody with technical background, but is also doing sales, and one inside salesperson, somebody who's handling the phone calls on the inside of the company. So overall, you have 2.5 people, but they get paid different amounts. Salesperson gets paid $230,000 because they're driving your sales most directly. The sales engineer is getting paid $140,000. They drive some of your sales, but they're also doing a lot of technical stuff, and they may end up with a higher base salary than the salesperson. So because salesperson has higher risk, you end up paying more for them than the sales engineer. And then the inside salesperson is $90,000. They generally get paid the least. Those are often entry-level sales positions, is the inside salesperson. All right. So the salary, how much are you paying? 230,000 for the salesperson, 140,000 for the sales engineer. And since they're only working half the year, half time, maybe 20 hours a week, on the 90,000 is 45,000. You also have overhead, typical overhead that you would put for benefits and things like that, retirement plans, health insurance is 35%. So you multiply each of these by 1.35, and you end up with 310,000 for the salesperson, 189 for the sales engineer, and roughly 61,000 for the inside sales. Total amount that the salespeople costing your company is $560,000 per year. You have one marketing person, and they cost you 200,000, and you're also spending $150,000 on marketing programs. Those could be collateral material, ads that you're going out there. It could be online ad spend, but you're spending a total of 150,000. So total marketing cost is 350,000. So in total, you're spending 910,000. So 560 plus the 350 is 910. And for this particular team, you get 10 deals per year. So you must be selling something that's very expensive, tended with 10 deals per year. Maybe it's 10 satellites, right? 10 deals per year. So your customer acquisition cost is that total divided by, the number of deals, 91,000. So for the product, there's different things that go into it than for just a pure online service thing. All right. And you'll find all the calculations and everything in the Excel sheet. All right, so one of the things that you'll be asked about repeatedly as you launch a startup, people want to know what is the lifetime value of your customer. And Carho mentioned that earlier. He said he was talking about something, and he said because your customers have a certain lifetime value, he does certain things. And so everybody should kind of have an idea of what the lifetime value of a customer is. Here's how you would go about it in a pure calculation. Again, it's in the Excel sheet and broken down, step by step. Let's assume that your average sale is going to be $12.50. So you're selling something on average. Maybe some things cost $9, some things cost $15, but on average, your sale is $12.50. And you've also calculated that the number of transactions per your customer per year is 4. So this customer is going to come back to your store 4 times and spend, well, we don't know how much they spend. It depends on how many purchases they make, but the average sale value is $12.50. The number of transactions per year per the customer is 4. Let's assume that the customer stays with you for 2 years and then moves on, okay? And also let's assume that your profit margin is 10%. And so the way you determine the lifetime value, kind of the easy one is, if you assume only one sale per every time your customer visits, so $12.50 times the 4 visits per year times the 2 years, and you end up with $100. And if you assume that the 10% is your profit, you really end up with $10. So this tells you, if you're really looking at the profit, it might, well, if you look at the $100, you know that you want to spend less than $100 to get a customer. That goes without saying, and then it may get a little bit more complex, but you're only going to make $10 on that particular customer in terms of pure profit. That goes back to you and your members of your LLC, or if your shareholders, goes back to your shareholders. These are all the terms, and I'm not going to go through all these terms one by one here, but I will go through them. But I wanted to have one place where you could find all the terms that are used in the Excel sheet. And this is complex, to say the least. And you can go and use different models and different Excel sheets. This is the one that we use, but your mentor may have different ones. I saw somebody submit one last semester, and I thought, wow, that's a pretty nice one. It was really clean, really easy to use. It didn't get to a lot of this stuff, but hey, it works. The key is that in the end, you want to have a good understanding of the financial projections for your startup, and you want to have a financial or multiple financial slides for your pitch deck. So here's the color guide for the Excel sheet. Yellows, you can change yellows anywhere. You shouldn't change greens and you shouldn't change purples. Essentially, the yellows are inputs, but greens are calculations, and purples are essentially when it's just displaying in one cell what was in another cell. So equals A3, that would be a purple, and the greens are calculated. You shouldn't touch either one. If you touch those, you break the Excel sheet and it ripples all the way across. And only touch if you know really what you're doing. You've taken a few financial courses and you're up to speed and you can modify it for your purpose. Okay, so this is where you're going to start. You're going to start in this section on the Excel sheet. I forget which tab it is, but you'll see this in the Excel sheet. And there's a few key things. For most of you, you're only going to have one product. So the product B is going to be 0, product C is 0, and so you can just zero those out. And you're going to have a price for your service for your product A, product or service A. But this is what you're going to be selling. So if somebody's going to be spending $25 to purchase your product, to become a member, or to buy something, this is where you put the price per unit, and the unit depends on what you're selling. I put commission rate here because some people have to pay commission. The simplest thing is to keep it at 100%. In this case, this startup has 3 products, one for 25, one for 35, and one for 10. And the commission rate, to simplify, is all 100%. And so therefore, subtracting the commission, you still end up with 25, 35, and 10 because it's 100%. Which means you're paying no commission. So you get the full amount here. So 25, 35, and 10, and the average is 26.67, which is calculated here. So the first thing is, for most of you, you're just going to put 0 in this, where it's 35, 0 where there's 10, and then put the price for somebody to spend money on your website or your service over here. Okay, the next thing you need to consider is for this worksheet to work, you have to start with a certain number of customers. And so, and so you're saying, well, how do you start with certain number of customers in month 1? It's just what gets the financial worksheet going. It could be done differently, but I just chose, it's easier to do this. So you start with some certain number of customers. In this, they're putting in that for product A, they have 100 at launch customers, 20 product B customers, and 10 product C customers. Okay, so now what is this rest of the stuff? All this other stuff here, the stuff you see in the peach color over here, is to determine what your lifetime value is. Okay, and it's all kind of worked out for you, but you have to put in the inputs here. First of all, you're going to have to estimate how many purchases somebody makes per month. Okay, so let's go back here to product A at $25. Let's assume that the product A for $25 was for 1 year membership, right? Which means the number of purchases somebody makes per month is 1/12, 1 divided by 12, right? They're paying it up front, let's say the 25, but to do this calculation, what you do is you divide the 25 by the number of months that membership is for. In this case would be 25 divided by 12, and you'd end up with what it is. In this case, we're saying that it's 25.25, not 1 divided by 12, but that they're making a quarter purchase per every month. That means that every 4 months, let's see, 1, 2, 3, 4, 4 times 0.25, they make 1 purchase of $25. Okay, so this is purchases per month. And here's what it's saying essentially is it takes 4 months for them to make 1 purchase. All right, so in every 4 months they make a purchase. The units per purchase, well, When you're signing up for premium and stuff like that, generally the units per purchase is one. But if you have a retail store, let's say you have a cannabis store and you're selling a number of cannabis products, your average customer might be spending close to $1,000, and they may be buying 4, 5, or 6 products, right? So this is how many units per purchase. And then the rest is calculated for you. So you could almost ignore the rest of this for now. Essentially, what these two columns are calculating, column 3 here and column 4, is what is the expenditure per purchase? And here it's calculating the expenditure per every purchase is $25. Okay, every time somebody makes a purchase is $25. And then, however, since we're saying only a quarter of the purchase happens in a month, right? Because we're saying every 4 months they make a new purchase, it calculates what's the value of that customer to you per month. And essentially the $25 divided by 4, and you end up with $6.25. So this is saying, how much is that customer worth to you every month? Let's say that it's a software as a service and you're charging $120, right, for the year. Well, then that customer's value to you every month is $10. 10 plus 10. It's not quite exactly that, but for this analysis, for doing this type of financial projections, it's more than good enough. So it's $10 every month. 10 times 12 is 120. And then for the year, they're worth 122, but every month they're just worth $10. And that's essentially what this value per month is getting at. That's all it really is getting at. And if you have multiple products, it figures everything out for you over here. All the things are figured out for you over here, so you don't have to do the calculations. So you have to have some faith in this sheet as we move forward. And I'll put up articles on LTV and CAC on perusal probably tomorrow. I'll be putting up a number of articles probably tomorrow on that. So you can read up more other approaches, other things. Talk to your mentors about CAC and LTV. They may have a different approach, an approach you prefer to take. It's perfectly okay. All right. The next part of the worksheet, you have to put in some inputs again. So this yellow is some inputs. So what is ACL? We have here. ACL is the average customer lifespan. In other words, how long is the customer going to be with you? Customers generally are with you for a lifetime. So there's generally industry averages out there, and you can find out what's the average lifespan of an e-commerce organic food customer? What is the average lifespan of an e-commerce electronics customer? What's the average lifespan of a software as a service customer? And you'll find out what the industry averages are, and just put that number in here. I like to put 2. I think it's a fairly decent one to put in. And then, so the average customer is going to be with you for 2 years, but you lose a certain percentage of your customers year to year. So what is your retention rate? What percentage of all your customers do you retain for the next year? And I put here 80%. In other words, if I start off with 10 customers in year 1, 8 of those 10 will remain in year 2, and 2 of those 10 will leave. Okay, so that's your retention rate. What is your profit margin per customer? You know, is it 10%, 20? And we're looking here at gross profit. What is your gross profit when you take away your revenue you bring in plus the cost to get that revenue? Maybe salespeople costs, maybe search engine marketing costs. It's some variable cost of COGS, a cost of goods sold, whatever that is. If you subtract that raw cost, which is not your operations, from the revenue, you end up with your gross, you end up with an amount, and then if you divide that by the revenue, you end up with kind of what the gross profit margin is. So you have to put something in here. 67 is actually pretty high. You may want to look at what that is and put that here. Discount rate, do 20% for now, unless you know what discount rates are. And months per year, 12. Why am I doing that here? Because you may change the time frame, and then this would all change. But in this case, clearly it's months per year is 12. And then your lifetime values are determined for you in 4 different ways. There's the simple lifetime value. That's generally the LTV a lot of people talk about when somebody asks you that. And then there's these other ones that produce a low and then a traditional lifetime value, which is a long equation. So when somebody asks you lifetime value, you can use the simple one, 258, which is very easy to get at. Or you could say it ranges from 173 to 346, depending on the formula you use, right? This is really important because you need to know how much money a customer is going to give to you over their lifetime to know how much money you should spend to acquire that customer. Because you don't want to spend more money to acquire the customer than you're going to get in value. Sometimes you really need to know how much value a customer will bring to you in 1 year because you don't have the funds to really consider the full lifetime value. So you may just want to know what's the value of a customer to me in 1 year. And then from that say, well, I can spend, as long as I spend less than what it costs for 1 year, I'm good to go. Over time, really what you want to do is spend much less than what it costs over the lifetime of the value of a customer. Okay, and then the next section of the worksheet, for the inputs worksheet here, has to do with trying to determine for software as a service, what is your customer acquisition cost? This isn't technical CAC per se, and you can use different formulas to get it. From a practical standpoint, this is what you're going to be doing, and let me explain. First of all, you're going to want to know what your growth rate is month over month. And so in your first year, this growth rate number is going to be, 145% month to month is a very high growth. But for a lot of businesses, the software as a service, you want that kind of hockey stick, that high growth curve for your first year, so you can end up making more money than you're spending in year one. Not all businesses can do that, but that's generally the goal. And then your expenses growth rate. So this is your revenue growth rate here at the top one, 145%. So that's growing like this. Your expenses growth rate is like this. And for most things except for the sales and search engine marketing that drives your revenue, right? With the exception of that, all your other expenses are generally fixed in year one. Whatever you spend in month one is what you're spending in month 12 from the vast majority of your operation expenses. But search engine marketing is different because the more you spend there, the more sales you get. So one is driving the other and vice versa. Okay, so that's your revenue, this first one, month to month. The second one is 100% is your expenses. And then now we get to what Fawn was just talking about, your cost per click or your pay per click. How much are you spending for every visitor to whatever platform you're sending them to, right? How much are you spending per click? And here I put down 3. Some things can be 10 cents, some could be $100. Your cost per clicks vary depending on what you're trying to sell. And then here, what I'm doing here, the next calculation that you need to put in an input is what percentage of your visitors are coming in from ad spending, right? And so we're saying 35% of the visitors are coming in from a pay-per-click campaign that we have on Facebook or Instagram or on Google. And the other 65% are coming in by word of mouth, tribal marketing. So 65% are coming in from tribal marketing, 35% are coming in from the ad spend, and so I put down 35% here. And then the next two numbers is what percentage are converting to become free members, and then from the free members, what percentage are converting to be paid members, right? And so I put 25% of the visitors there are converting to become free, and 15% are converting from the free to become paid. And then it determines what you're really paying across all your visitors. You're really paying on average $1.05. It's less than the $3 because you have 65% coming from tribal marketing, which drives down your average pay-per-click to $1.05. Your pay-per-click for free members is $4.20, and your pay-per-click for paid members is $28. So for every paid member, you're spending $28. Right? And so whatever you're making from that person, probably in year one, should be above $28. So when you're saying, what should we price ourselves at? well, you should definitely price it for greater than whatever it is it costs you to acquire that customer. If you just price it at 28, you're going to be breaking even your whole life, right? You don't want that. I like to price it at 3 times that. So whatever I'm selling, if my customer acquisition cost is 28, I'm going to be doing 3 times 28. Okay, so this is the input sheet that you have there as you move forward. So there's 3 sections. The very top section where you need to put in your price and number of customers, how much they're purchasing per month, and how many units they're purchasing per month. And then the next piece is, what's the average customer lifespan? What's your retention rate? What's your profit margin, right? And then finally, you come down to the bottom and you put in your revenue growth month over month for year 1, your expenses month over month for year 1, your pay per click, the percentage of your visitors that come from paid ads, how many convert to free and how many convert to paid. And then you get all those 3 things. I'm going to stop here, even though this goes into more stuff, but you've been given a lot of stuff today. I'm just going to open up the Excel sheet and share it with you for a moment and just review that. And what you should do, I'm not going to require you to do it, but what you should do is at the very minimum, do this first sheet for next week. It's not a deliverable, but I highly recommend that you do it because otherwise the week after, when everything is going to be due, it's going to be difficult to catch up. So you don't want to be playing catch up on this stuff. So 1 second while I switch what I'm going to share with you. Hold on. Okay, I'm going to share the next screen. It's going to be the financial template, and you all have this. Okay, so you all have this, the financial template. So what did I just review with you? I just reviewed this inputs in the slideshow. I just reviewed this input. So you should all fill this out for yourself and play with these numbers and just see what happens as you make different assumptions. Clearly, these are all assumptions. Now, if you do what Fawn was saying and you're running campaigns, then these will no longer be assumptions. This will be real numbers that you can put in here for conversion to free, conversion to paid. And so I would work on this section, fill in, these numbers. So for example, let's just run through an example. Let's say I have a software as a service company and they're going to pay $120 each member who signs up. For the paid version, it's $120. So I'm going to put 120 here. I'm going to zero this out because I don't have another product. So I'm going to zero this out because I don't have another product. Okay. I'm also going to zero this out and zero this out. Okay. And so now I have $120. There's no commission. So I get all the $120. I'm not paying any salespeople for anything. It's just me and my team that are making the sales. All right, so average customer lifespan, let's say that the average customer lifespan for this might be closer to 3 years. Let's say this is a realty business, and in real estate, the average customer stays with the platform for 3 years, all right, instead of 2 years. The retention rate year over year, let's say that's a little lower, it's 70%. So we're only keeping 7 out of every 10 customers, paid customers, for the next year. The profit margin there is going to be pretty high because there's not a lot of costs that go into it. So I'm going to keep it at 67%. And like I said, don't change the 20% or the 12. And I find out that the lifetime value of this customer is around, purchases per month. This has to be 1 divided by 12, right? Because it's 120 for the year. So that changes things. So 1 divided by 12 is 0.08 purchases per month on average, and that makes it 1 unit per purchase. So now my lifetime value is $360, which makes sense, right? 3 years times 120, 360. That's a simple one. The more complex one, which takes into account profit margins, says they're really worth more like $241 over the lifetime. All right, so let's say I keep the growth rate the same, the expenses the same, and the cost per click. In this particular area, I actually know that the cost per click is going to run at least $6 to have any to get decent results. And then the conversion, the percentage is 35%. Let's say that's okay. The conversion to free, though, is maybe it's a little lower. It's 15% convert to free and 10% become. So now my customer acquisition cost ends up being 140. Lifetime value 241. Customer acquisition cost 140. That's okay. However, the problem I have here as a startup is that I may not exist past year one. And all I get for that customer is $120 for that first year. But it's going to cost me on average 140. So I'm going to lose money. So I need to say, okay, what do I need to do? Well, I need to drive down my cost by driving down my average pay per click. And I do that by doing more tribal marketing. If I can get more tribal marketing going, maybe I can reduce that down to 25%. And then now my customer acquisition cost is 100, less than the 120 in year one, and I'm okay. So you should all be able to do this first sheet. I'll just briefly go over the other sheets and we'll get into them in detail next week. This is your year one breakdown. It does revenue on the top here divided by your minus your expenses, which are down here. These numbers for your revenue all come from your inputs over here. So you shouldn't be editing anything here with the exception of month one expenses for your operation expenses. This is how much it's going to be spending for promotional marketing to get the number of customers you want to get. So, and it's calculated for you. And then the next tab is a 5-year thing, and it's all done for you. There's some inputs in here, which we'll go into detail next week, but inputs for employees, how much are your employees going to cost you, what your growth rate from year one to year 5 is going to be. And then everything else is then calculated for you, and you end up with a nice income statement. You end up with a net present value, what your valuation is. You end up with a cash flow statement and a balance sheet. Okay, but for all of you, for next week, if I were you, and feel free to send it to me with your deliverables. I'm not going to require it. You don't get brownie points if you do it, but you get to get started on this and thinking about this moving for next week.